basics of accounting. And so before I start, can you tell me what do you understand by accounting?
What I have
Like,
understood is that
yeah, yeah.
it is,
And I'm not looking at the technically perfect answer over here. You can tell me
right.
what comes to your mind.
It just is recording financial transactions. That's what I understand as accounting. Like anything that we do in day-to-day life that has anything to do with money and regulations, we just so if I buy something, I sell something, um, I like financial transactions. I feel like you record somewhere and in a nice way that you can
Mhm.
understand. That's what I like understand accounting is.
Yeah, since you're almost over there, so it's going to be easy for me to cover this part of the session with you. So see, before we understand what is accounting, we should try to understand what is an activity. So there are basically we can classify activities into two types, very basic stuff over here. There are economic activities and there are non-economic activities. Economic activities is when you can actually measure the transaction in terms of money. It is usually in the form of a business transaction. You may sell some goods or service to your customer, or you may buy something from a vendor, or goods or service from a vendor, or it can be even you are having some financial transactions between two parties, loan, or paying income like dividends, interest, etc., or even as simple as earning salary from your employer. So these are all various financial transactions, even investment. All of this comes under economic activities. Non-economic activities are things that we do out of love, affection, social obligation, etc. Basically, what we do between friends, not lending money to friends, but then visiting a friend, saying hi to him, or going with him just for a walk, all those sort of things, or having spending time with family, or doing something for your kids, spending some going to the park with your kids. All these activities are non-economic activities, and they cannot be essentially measured in terms of money. When it comes to accounting, we're going to solely focus on economic activities, and that is where the concept of a transaction comes into the picture. And so basically, transactions is something that involves exchange of goods, services that can be measured in terms of a monetary value between two or more parties. And recording these transactions is what is known as bookkeeping or accounting. So bookkeeping and accounting have slight differences in it, but at this stage, bookkeeping and accounting are the same in terms of recording of transactions. So that is the basic things of accounting. You should know what is a transaction. So it can be like A has sold goods worth 100,000 to B. So B has purchased goods worth 100,000 from A. So A has to account for this sale in his books of accounts, and B has to account for this purchase in his books of accounts. And after a period of time, since B has bought the goods from A, B will have to pay the money to A, right? So he will pay, maybe first he will pay 50,000 as a down payment. So A has received 50,000 as down payment from B, so that will happen on a particular date. Now, B owes A 50,000 rupees till that amount is, settled. Now, let's say after 2 weeks, B is paying 48,000 rupees to A and saying this is in full settlement of my balance. So in that case, we know that B was owing A 50,000 rupees, that is 100,000 minus 50. But then they have settled this balance for only 48,000 rupees, which means that 2,000 rupees is actually a discount. It is a cash discount. And this discount is an expense for A and an income for B. So, how they are going to account these transactions is what we see in accounting. All right. Any questions so far?
Yeah. No, no,
Okay.
it makes sense. So you're talking about anything that has a financial value, anything that is monetary transaction,
Yeah.
that anything that has to do with money or goods or
Yeah.
services sold is
Yeah.
accounting. Anything that has nothing not to do with money and non-economic, it's not
Yeah.
accounting, which makes sense.
Yeah. So
Yeah.
this doesn't have to mean that the transaction has to be in cash. It can be in kind also. Like I'm giving you my car in exchange of your car. So it's a barter transaction. So here
Oh,
here there is no cash involved, but I can still assign a monetary value based on the value of assets that is being exchanged. So let's say my car
right,
is worth 200,000, your car is worth 250,000. So it can be I'm
right.
getting an asset worth 250,000, whereas you're getting an asset worth 200,000. So that can still be recorded. So it is not necessary that the transaction has to be in cash. It can be in kind as well. But then comes the concept of valuation over there.
That makes sense. Thank you.
Yeah. So moving on. In accounting, we have this concept called the double entry system. So by double entry, we mean every transaction has got two aspects in it. The first, we call it debit, and the second, we call credit. So any transaction, there is always a debit aspect to a transaction and a credit aspect to a transaction. This is what is known as the double entry system. This is the most foolproof system of accounting that has been prevailing for a very long time, and it is still prevailing. There is a single entry system of accounting which is actually used by very small businesses, wherein you just track your debtors and your creditors, and then you just do some balancing, and then you get to know what your sales is, you get to know what your cash is. But then in this double entry system, you record every transaction, you post a debit entry, and then you post a credit entry, and these two should be equal. So that is what is called the double entry system of accounting, which is what all the formal system of accountings uses today, irrespective of which ERP you use, irrespective of which software you use. The double entry system of accounting is what we follow, wherein there is a debit aspect for a transaction, and then there is a equal and opposite credit aspect for a transaction. Now, you can see there's a formula that says assets is equal to liabilities plus equity. So that is the accounting formula that we have. So assets, is the background noise too much at my end?
No, sir. No, it's good.
Okay. Because I
Thank you.
have I've kept the windows open and there's a few vehicles on the roads. Okay. So assets is generally denoted by the debits, whereas liabilities are generally denoted by the credits, and equity is also over there. So we'll see this in detail once we come to the, uh, you know, to the later chapters of the basics of accounting.
I
Okay.
actually memorized this one. I memorized
Okay.
this one.
Yeah. So as you can see, I told you there are two aspects of a transaction: debit and credit. So the debit is derived from the Latin word debere, and it's like I'll show you what a T account look. I'll show you what a T account looks like, and in a T account it will be on the left hand side. So I'll just quickly show you how a T account would look like. Change who I'm sharing. I hope you can see an blank Excel sheet.
Oh, yes. Yes, I can see that.
Yeah. So this is just. So this is what is called as a ledger. Okay. Uh, you have uh, a debit side, which is usually on the left hand side of the ledger, and then you have a credit side over here, which is the right hand side of the ledger. So you normally have, for every transaction, you're going to record three aspects. That is, this is what is called the I call this the two-dimensional accounting. So you have a date for a transaction, and then you
Okay.
have particulars, like particulars of like what ledger you're posting it to, and then you have amount over here. Similarly, you have the same amounts over here. So this might be one account. So this can be any account. This can be cash account, or this can be, let us say, purchases account, Any account, this is what the format of the account is. This is what is called a T-shaped account. And this is what is taught in colleges when we are learning accounting. That's the T shape of accounting over here. Okay, so in the T shape of accounting, you have a debit transaction here, credit transaction. We'll come back to this a little later after we see what is a journal. Is there again noise? Someone is building in the apartment.
Yeah, there's a little noise, but it's okay. Not distracting. It's not distracting. It's fine. Just a little bit in the background. It's okay.
Okay, right. All right, so let me just go back to the slides. Yeah, so in the T account that I showed to you, we sum up all the debits and then we sum up all the credits, and then there is a difference. If the debit is more than the credit, it is called a debit balance. If the credits are more than the debit, it is called a credit balance. So that's how it works inside the account. So when I say account has a debit balance or credit balance, does it have more debits in it than credits? That is what it means.
So okay, and the okay,
Yeah.
okay, okay, and that kind of shows profit and loss type of thing. I'm
We'll come
assuming.
to that. That's like ultimately that's where it all reflects over there. We'll come to
Okay.
that part as we go.
Yeah. Sorry for going
Okay,
ahead. My
no
bad.
problem, no
Sorry.
problem. Now that we have seen what debit and credit is, we should also now understand the kind of accounts that we have. So all accounts are classified into three categories. And what you're seeing right now is called the traditional classification of accounts over here. Okay, so there are three types of accounts. First is a personal account, second is called a real account, and third is called a nominal account. And personal account is basically you actually have an entity. It can be an individual, it can be a corporate, it can be any other kind of entity, but there is actually an entity involved in the transaction. It can be like, Anish is one entity, Rushit is one entity, or, it can be even like, something like Coca-Cola is an entity. If you're having a transaction with Coca-Cola, or if you're having a transaction with the Google or group or with the Facebook group, those are all personal accounts because that account represents an entity at the other end. Okay. Now, real accounts are basically accounts that are in the nature of an asset or a liability. Okay. Or mostly it is asset only. Or it can be liabilities also, but this is in the form of cash. It can be in the form of my tangible assets like my laptop, my electronic items, my buildings, my properties, my land. All these things are what is called as real account. And then comes nominal account. Nominal account, they say it is a temporary account because this account has got a validity only for one accounting period. In the next accounting period, this account starts from zero. So typically, these are all expenses and incomes. So it can be in the expenses in the form of, you say, insurance expenses, rent expenses, your purchase of goods, in the form and in income, it can be in the form of your turnover, your other income, and those sort of things. Basically, whatever comes in the income statement of the financials is a nominal account. All right.
Okay. Yeah.
Yeah. And at the end, as you can see, they are reset to zero at the end of the financial year because at the end of the year, I will be transferring the balances in these accounts to my profit and loss account, and there I will end up with either a profit or loss depending on whether it is my expenses that is higher or my income that is higher.
Right.
These two category of accounts end up in what I call a balance sheet, and nominal accounts will be in my profit and loss account.
So the balance
Yes,
sheet has personal accounts and real accounts,
correct.
and nominal accounts are in balance sheet. Okay.
Exactly. This is the
Oh,
traditional accounting. There is a modern category of accounts also. It is slightly similar to this. Unfortunately, I have not added that content over here. I think you would have seen that content in the session that Hema took. It is assets, liabilities, equity, expense, and income. So it is very
yeah.
similar to this. So it's just that over here for real accounts, These two category of accounts have been classified as assets, liabilities, and equities into three. Okay, they are not focused on if
Right.
you're personal or real, whatever it is. And then you have nominal account. Income and expenses are nominal accounts.
And they have like the same, but the answer is still the same, no matter
Yes,
what you learn, right? What
yes, yeah, that's
you
what. Yeah,
okay.
you're right.
Oh, perfect.
The reason why I prefer to go to the traditional system of accounting is it actually focuses. You'll see on the next slide. This model focuses a little bit more on the logic of the transaction to understand the rule of accounting. Whereas in that asset, liability, equity, it is just like a plus equals debit, minus equals credit. So that it goes on that kind of a rule. It is also correct, and,
Yeah.
and and it also works, but this actually goes with a little bit logic into the transaction over here.
Right. And
So as
that's
you
why
can
I'm here
see,
because I
yeah,
memorized it. I
mhm,
memorized it, but then I'm forgetting it because I don't know how to apply it. I'm
yeah,
like, wait, how does this work? Yeah.
yeah,
So thank you. Thank you.
yeah. So in case you are dealing with a personal account, so personal account, I repeat, it's you have an entity represented by that account. It can be an individual, it can be a corporate, it can be the government or anyone who it is. In case of a personal account, the rule is debit the receiver and credit the giver. So if the person is receiving, that account has to be debited. If the person is giving, that person has to be credited. For example, I borrowed money from Rushit. So in this scenario, Rushit is the giver. So Rushit's account should be credited. And I am the receiver, but then it is my books of accounts. So I won't have my own account in my books of accounts, but I'm getting something from you in the form of cash. So cash is a real account, and for real accounts, the rule is debit what comes in, credit what goes out. So cash is coming in from me. Rushit is the giver. Cash is coming in for me. So I'm going to debit cash. Real accounts, debit what comes in, debit cash, and credit the giver. In this example, Rushit is the giver. So it is credit Rushit. So the entry is going to be debit cash and credit Rushit over here. So that's the
So we have
principle
to
for, yeah,
so we have to kind of figure out like in that transaction what is a personal account and what is a real account, and then
exactly.
kind of
Yeah.
okay.
It's very simple. It might sound very complicated initially, but once you get a habit of it, it's all about analyzing a transaction. What is a personal account? What is a normal? What is a real account? What is a normal account? This comes subconsciously once you get used to accounting, and this comes very fast subconsciously. Like once you start practicing journal entries, you'll get to know like X sold goods worth 5,000 to Y. So how do you account in the books of Y? So in the books of Y, X is a person giving. So X has to be credited, and Y is receiving goods. It's a real account. So it'll debit my goods and credit Y over that.
Right. So it also depends from whose perspective you're looking at, right?
Yes, exactly. Yes,
Okay.
that's right. So every
Perfect.
time, every time you're trying to figure out something, you should first understand whose books of accounts am I standing on for doing the accounting. Which side of the transaction am I on?
Right.
And
That
then
makes
comes
sense.
a concept called journal entry. Journal entry is called the book of original entry. Now, journal entry is the most fundamental concept of an accounting. So, how the whole skill of accounting is in translating a particular transaction into a journal entry which says who gets the debit, who gets the credit. That's the art of journal entry. And how do you do that? By applying the golden rules. These are the golden rules of accounting. So you take a transaction, apply the golden rules of accounting, you land up with the journal entry. Okay, let us see some example. Okay, I don't have examples in the slide. And go back to my Excel sheet again. Let me know if it is visible, the Excel
Yes.
sheet.
Yes, sir. Yeah.
Okay, now
Absolutely.
I'll introduce you to a concept called the journal book or the journal register. Okay, so it also has similar columns that we have. So we have date, we have particulars, and then we have amount. Okay. Okay, so we have debit amount, and then we have credit amount. Debit is always in the left, credit is always on the right. Okay, so let us say today, that is the 6th of March, uh, you know, I went and deposited, or not deposited, I went and purchased goods worth 100,000 rupees from a vendor called A. That is my transaction. So it is a purchase transaction. So purchased goods worth 100,000 from A Limited or A Inc. We use limited here in India. Okay. And this happened on 6th of March today. And then what happened on, let's say, on the 9th of March, I paid A Limited 50,000, and on 15th of March, I paid A Limited not 50, I paid only, let's say, 45,000. How do we account this? And this is like as final closure. Okay. Now, the first entry that we have is called purchase goods worth 100,000 from A Limited. So based on what we just discussed, can you give it a shot at what the journal entry for this should be in my books of accounts? I'll help
Okay.
you with the date. Date should be just
Right. Okay. So,
what what is
debit
the yeah.
debit the cost of goods account or like purchase
Okay,
account,
good, very good. Purchase
and
account.
credit the limited company account.
Yes. So credit
Because
the limit company. Yes. So what I'll do is 100,000.
is that correct?
Yes, that is absolutely
Oh,
correct.
thank you.
Yeah, see, that's what I said. See, once you apply the logic, it's very easy to get the answer. So, sorry, my system is working on Indian number system, so it looks like
Yeah, I
this.
figured.
Yeah,
Yeah.
yeah. So, this is how, this is the first transaction that you, and then usually for every journal entry, we should have some what is called as a narration. Okay. So narration
Oh,
goes something like being goods worth 100K purchased on credit from A Limited. So basically, what we do is in this narration, we basically try to summarize or add additional data into the transaction so that when someone is looking at this transaction later on, they will know what is the background or what is this transaction related to. For routine transactions, you may not have to give an elaborate narration, but then sometimes you may have some non-standard journal entries that comes once in a while. You'll have to write probably the story over there, not like a big essay or something, just a short narration of what the transaction is about that. So this is how uh, a journal entry is posted or is recorded to purchase. And
okay.
then let us go to the next transaction that we have. The next transaction is happening on the 9th of March, right? So there is a payment happening to A Limited for 50,000 rupees. Try to give this a shot by
So
applying the
in this
golden
one,
rules of, yeah.
so this one, I would say, so cash is going out, debit the
Yes.
expense. So like debit the cash account and credit the
Cash is, if cash
limited.
is going out, so what is it? What to do with what goes out? I said debit what comes in, credit what goes out.
Oh, credit the
Yeah.
cash account and
Okay. Hmm.
But isn't so? But the company is the receiver, right?
Yes. So what happens to the receiver?
We debit it, debit
Yes.
the receiver.
So I debit A Limited. Who is the receiver? Receiver is A Limited. And what is going out? Cash is going out. See,
Right.
we first apply, okay, who is the receiver? Who is the giver over here? The receiver is A Limited. 1 second. I think someone is trying to join. What's not? Hi, Rachna. Can you hear us? Hello, Rachna? There's something. Okay. Rachna, you're on mute. You would let us know if you can hear us.
You might be fixing audio, right? Sometimes it
Yeah,
happens to me
yeah.
when I join it.
All right. So while Rachna, let me know
Yeah.
once you're fixing your audio. We'll continue with what we do. Okay. So, like, see, in this case, always look at in a transaction, who is the receiver, who is the giver. So in this case, the receiver is A Limited. So I'll be debiting A Limited for 50,000 rupees over here. The giver is I am the giver. But then, if I am the giver, I cannot account it in my name because it is my books of accounts. It's like I cannot have my own account in my own books. So I cannot be
All
having
right.
transactions with myself in my books, right? So if it is me, that means there is a real account that is involved. One of my real accounts is involved, which is in this case, it is cash. So in case of real account, the principle is debit what comes in and credit what goes out. So something is going out from you. Yes, Rachna, we can hear you now. Rachna, are you there?
Sorry for the delay, sir. I joined late, sir. A little bit late, sir, because of the
No
issue of
problem.
system.
I have recorded the session. Okay, I will share the recording video link with you. You can have a look at it later today. Okay.
Yes, sir. Thank you, sir.
So what is going out? Cash is going out. So I'll be crediting cash over here for 50,000 rupees over here. So this is how this transaction goes. Now, see, let us say this is the account of A Limited. So this is what is called a ledger. So this is the ledger account of A Limited. So here, if you see, is A being credited or debited over here?
Credited.
Yes. So I need to post this entry in the credit of A on the 6th of March, sorry, on the 3rd of or 6th of March. And I will mention here purchase. And then I will give this amount over here. Okay. And then on the 9th of March, is this debit or credit for A?
Debit.
Yeah. So I need to, this activity that I'm doing right now is what is called posting of entries. Okay. This is called recording of entry and this is called posting of entries. So I record the entry in the journal book and then it is posted into the ledger over here. So
So
here I need to give,
basically,
yeah,
ledgers are like isolated accounts of like
yes,
particular journal. Oh, so we record a transaction, we put in a journal entry, and
yes,
then to make it better or like make it more clearer, we have different accounts that show like what we debited, what we credit. That's
exactly.
what's called a ledger. Fair,
Yes,
fair,
yeah.
right.
So this is
Thank you.
called a ledger over here. And then, so then see, I have recorded the debit over here. And then there's a concept called balancing the ledger. As of now, you can see the credit is more than the debit. My credit total comes up to 100,000, whereas my debit total is only 50,000. So how do I
Yes,
do a
sir.
balancing? I will actually have to take this total over here, and then there is a balance over here. So I'll just call it balance. Is nothing but minus sum of this much portion. So I have a balance of 50,000 over here. Got it?
Yep.
And now what happens on 15th of March, right? Fast forward to 15th of March.
It's the same entry, but like the amount would change from 50,000 to
Absolutely correct.
47, right?
Yes, yes. So instead of 50,000, I'm only paying 45,000. Correct. Now, if I have to post
Right.
this entry, it's going to be the same way. I need to do the posting over here. And then again, it's going to be cash. Amount is going to be 45,000. And then you can see the balance appears as 5,000 over here. Now, what this means is I have a credit balance of 5,000. So this is what is called balance carried forward. And in the next accounting period, this is like the end of the accounting period, okay, of one accounting period. Now, let's say it's going to be like 31st, let's say my accounting period ends in 31st of March. Okay,
Right.
so 3/31. This is my end. This is my end of my accounting period. On this date, I have a credit balance of this much. So what happens is then this balance is what goes to the next accounting period as my opening balance over here. That is that is what I said for normal. This happens only for personal and real accounts. It doesn't happen for nominal accounts. So there is the balance brought forward from previous accounting period. This is going to be this. This is on the credit side. So this is a credit balance that I have. Okay.
Right.
Yeah. Now there is one important information I mentioned. This 45,000 was for final closure of the accounts, which means after I pay this 45,000, I don't owe any money to this party. But as per my books of accounts, you can see there is a balance of 5,000 rupees that is still there. Got it?
Yeah.
So,
Now, yes, Rachna.
Imagine companies at 2013, it starts from 1st April to 2025, any month, and then till 31st of April till 31st March.
Yes. I didn't understand, Rachna. Can you just repeat that?
As per Companies Act 2013, now as per what like the latest the batch, they are saying from 1st April 2000 any month any year till 31st March of any year.
Yeah. So
As per
31st
companies
March
for
is
as per
so
companies
30.
nowadays follow.
Yeah, companies follow that, but let's not go into that. I'm just trying to explain accounting over here. So no need to go into that part now. Okay. This is just like opening and closing over here. Okay. Now my books is showing 5,000, but I don't owe money. What that means? Any idea what that means?
Like your books is showing 5,000,
Yeah,
but you
but I
don't
don't. Yeah, exactly. So what would it be in this scenario?
like wait. So you don't owe 5,000, but wait, I think you do owe 4,000, right? 100,000
I
and like
I I
95.
do I do as per the books.
Okay.
The way I have accounted it, I do owe. But in
Right.
actual scenario, I don't owe.
Oh, because it's final. Like they gave a discount or
Yeah,
something like that.
exactly. So this is a discount that we have over here. Okay. So now discount, is it an income or an expense for this entity?
It would be like an income for
Yes. So what is the rule for income?
Debit
credit
all
the income
income
and
and
gains.
expenses and losses, and then debit all credit all the income. I think.
Yes,
I
you
know.
need to credit the income. So here I have discount, which is an income. So I'm going to credit here 5,000 rupees. And then this total becomes 50,000. All right. Now I need to update the
Yes.
posting over here. I'll still go for again same 15th of March, and then I'm going to go for discount. Okay, and the amount is going to be 5,000, and then my balance has become nil over here. You see,
Right.
this is the recording of a journal entry. So this journal entry is the primary record of any accounting transaction that we have. And then this journal entry is later on posted to a ledger like this. So I have done it only for A Limited. You will have a similar account for purchases. You'll have a similar account for cash. You'll have a similar account for discount, wherein you're going to see these transactions reflecting in that way over there. So this is what is called a T structured account over here.
Right.
Okay, clear? Any doubts so far?
No.
Also
This is
understood.
good.
Okay, okay, great. Now let me go back to the slide. Okay, slide is visible, right? Journal entry.
Yes, sir.
Yes, so we just actually saw this. So so what is posting? Posting is basically moving the transactions from the journal book to the ledger. So you remember on the Excel sheet on the left-hand side, I had a journal book from where I was posting the entries into the ledger. And then there is a concept called balancing the ledger at the end of an accounting period. So this accounting period can be anything that the user defines. Like what Rachna mentioned, many companies will actually go for the fiscal year end, which is March 31st in India for most of the companies. But like there may be people who may want to close their books on a monthly basis, on a quarterly basis, etc., based on how they want their reporting to be done. So that is why we always we avoid using the term at the end of the year, at the end of the month, etc. We usually use the term at the end of the accounting period. So it can be what the user defines it to be. So if the debit side is greater, it's a debit balance, and if the credit side is greater, it is a credit balance. Okay, so that is how what do you say? A ledger is created. Now, so far, just think the chronology of whatever we just saw. I'm just taking a step back over here. We saw what is a transaction, okay, and the two aspects of a transaction for double entry system, that is debit and credit. So debit has to equal to credit. And then we saw the traditional classification of accounts for the golden rules: personal account, real account, and nominal account. Okay. Then we saw how to record the journal entry, the books of journal, by identifying which are the accounts that is getting affected. Now, not every journal entry will only affect two accounts. Like if you remember in the example that we did in the end over here, here I have more than two accounts in one journal. But if you see, my totals are the same. The debit and the credit, the totals are the same. So
Right.
sometimes so this is what is called as a compound journal entry. This is called a simple journal entry where you have one debit and one credit for the same amount. But then you may have multiple line items in a journal entry, all totaling up to the same number. So here you have 1:2, you may have 2:4. I have even seen entries like 25, 30, 100 is to 100 on one side and 100 plus on the other side. But then at the end of the day, the debits and the totals will match. Okay. So those are called as compound journal entries where you have more than one line item each for debit and credit. Now, what
Right.
happens next is this is after recording all these series of entries. Now, I'll just show you over here. See, here I have cash, I have discount, I have purchases, and let's say I have capital also. I'm keeping this account as a balancing account. So let me just hide these for the time being. This is one account A Limited, no change over here. I'm going to title this account as purchases. Okay, and I'm going to post this entry into the purchases account over here. So whereas if you can see I have only one entry in purchases over here. Okay. So I'm going to post this entry over here with what's the date? 6th of March. It's going to be A Limited. my amount is going to be 100,000.
Wait,
If you
I have
can
a
see,
question.
yes.
So on the journal entry, we wrote credit the A limited and debit the purchase. But on the purchase
Exactly.
account, we're putting this as debit.
Yeah. So I'm debiting purchase account, right? I'm
Oh,
debiting purchase
oh,
account.
oh,
I
makes
am
sense.
crediting
Sorry.
A over here. I am crediting A
Right.
over here. So this transaction is reflected in the ledger in this way. This is the debit aspect of the transaction, and this is the credit aspect of the transaction.
Right.
1 second.
Okay. Because it's a purchase account.
Just 1 second.
Yeah, sure.
Yeah. Rushit, you're asking something. Sorry.
No. What I was saying is that on the journal entry, you put purchase and limited, right? Debit and credit. And on the purchase account, we're putting um, like limited as debit. So just
No, this is just a what do you say? This is just a what do you say? The reference. This is what matters. I'm debiting over here
I
100,000.
see what you okay. So
I'm
that's what I was
crediting over
getting
here.
confused at.
Yeah.
So we're just putting like the what do you call it? The particulars. It's like that, the debit.
1 second.
Yeah, not an issue.
Yes. So this amount is matching over here. So you can see every journal entry, it has to be having the respective posting into the GL.
Yes.
Okay. This is just a reference. Like if I look at my purchase accounts, okay, I purchased 100,000 from A and maybe 150 from B. So this just gives you a reference over here. This is not where this is the posting that counts. How much I
I
posted
see what
to the debit or to the credit over here.
that
So
one's
this is
just to
just
figure out.
this is just the counter side of the transaction I'm mentioning over here.
Okay.
Okay, ideally it should come like to A limited, by A limited, and all those sort of things. But then these days we don't focus on those sort of
Right.
to and buys when we are looking at accounting entries. Okay, so now I have done purchase. Now in the case of purchases, my debits are more than my credits. Okay, wait, I got a circular reference. Okay, so over here I will not have a balance in my credit. I'm going to have a balance in my debit side because my debits are more. So this account is going to have a debit balance. This is a nominal account purchases. It's an expense. It's a nominal account. So I will not be doing a brought forward for this. So the balance over here will eventually reflect in my P&L account.
Because it's a nominal account.
Exactly. If it's a nominal account, at the end of the accounting period, all your transactions balances will go to the P&L account. But for the sake of explanation, I'll just keep it as balance over here. Okay.
Oh, because they're all income and expenses. Okay, that makes
Exactly.
sense.
Yeah.
Okay.
So this account has a balance of 100,000, but it's a nominal account. I will not. So this account gets zeroed out at the end of the financial or at the end of the accounting period. Okay, so that is with respect to purchases. Now the next account I have is cash. Okay. Now cash is slightly an interesting account because as you can see, the first transaction I have for cash over here is on the 9th of March. There is a payment of 50,000 rupees, right? So cash being a real account. So what is the rule for real account?
Debit what comes in, credit what goes out.
Yeah, so here cash is going out. So I should be Debiting or crediting?
Crediting. Credit what goes up.
Sorry, Rachna?
Sir, he was disturbing from the 10th, sir. I'm telling him to be silent, sir. Otherwise, I can't listen what are saying, sir.
Who?
Rush, sir.
Sorry?
Rush is not allowing me to listen what are saying, sir. Continuously, he's talking, sir. Continuously, sir. Ask him to be silent for some time, sir. I can't hear what are saying.
He's clarifying. He's also participating in the session, right? So he's clarifying he's participating in the discussion. You can also participate in the session.
So sorry, I didn't mean to do that. My apologies. So sorry about that.
No worries, no worries, no worries. So okay, so here if you see the date of the transaction is 9th of March, and it's a payment that is happening, right? So it's the payment is going to A Limited, and the payment is going as 50,000. Okay. Now, when it comes to cash account, there is a thumb rule. Cash account cannot have a credit balance because you cannot pay the money that you don't have in cash. You can pay it in other ways, like derivatives and all those sort of things are there. But when it comes to cash, you cannot have a credit balance in cash. You can have a credit balance in your bank overdraft or in your bank loan and any sort of those sort of things. But this is like hard cash, so you cannot have a credit balance in cash at any point of time. So in this scenario, what I'll do is I'm going to bring one entry just to balance this situation off. I'm just going to on the 1st of March, I'm going to bring some capital over here. Just for the business capital, I'm going to just bring it as 100,000 over here so that this account is having a balance over here. So my balance of my cash is again 50,000. I had 100,000. I paid 50,000. At the end of the period, I'm going to have 50,000 cash, and this is going to come into my balance brought forward of April over here because this is a real account. This account will the balances will continue in the next period also. All right. Clear?
Yeah, that's fair.
Okay. So that is with cash. Then I have one more account over here called discount account, right? So I'm going to, I'll just easier to copy this account. Sort of. So in the case of discount account, it's going to be the same thing. So let me just delete this. So it's a debit. So discount is debit that I have. It's an income, right, over here. Sorry. Yes. So yes. So on the 15th of March, I got a discount income of 5,000, right? So A Limited again over here. Amount is going to be how much? 5,000. This is the accounting for this account. So discount. Now this account is an income account and it has got a credit balance over here of 5,000 rupees. So this also gets carried forward. Okay. Now I have one last account that I just wanted to make, which is my capital account. Okay, just to bring the whole contribution over here. So remember, I brought cash over here, same capital over here. The other aspect of this is the debit of this transaction. I'm going to bring the credit of this transaction over here. So on third one, cash, 100,000. Okay, so this is my capital. So this is basically, I brought in a capital of 100,000 as cash and then done these transactions over here. Clear so far?
Sir.
Yep.
Any
Yep.
confusions? No, right? So I have now 1, 2, 3, 4, 5 ledger accounts with balances. Okay. Now I'm going to prepare something known as a trial balance. Okay. A trial balance is the first set of statement of accounts. Okay. It is not a book of account. It is a statement of accounts which summarizes the balance of all my ledger accounts. Okay. So how many accounts I have here? So first account I have here is A Limited. Second I have is purchases. Then I have cash. Then I have discount. And then I have capital or equity, whatever. Okay. So these accounts over here. Now there some balances are debit and some balances are credit. So for A Limited, what is the balance? Can someone tell me?
100,000.
No.
100.
I meant the balance.
Oh, it's 0.
Yes, absolutely. It is 0. Okay. For purchases,
0.
no, there is a
No.
balance.
Oh, 100,000 credit.
Debit or credit?
Credit.
Is it debit? It is not credit, it is debit because my debits are more than my credit. So if my balance is being written in the credit side, it is a debit balance because I have more debits over here. So this is a debit balance.
Oh, you're using that
Yeah.
to offset the right side. Okay, makes sense.
Exactly.
Makes sense.
Yeah.
Sorry.
Yeah. So this is a debit balance of 100,000. Now coming to cash, what is my balance?
$50,000 on the debit. 50,000 on the debit side.
Actually, no. We missed to post this transaction over here. So let's do
50,000.
that.
I think so 50,000 will come in that credit side. I think so.
No, we missed one transaction. On the 15th, this transaction is not posted over here. So let me just do that also. A Limited. And it comes this one. Now tell me what is the balance of cash?
45,000. I think so. 45,000 is.
I have 1 lakh. I have 100,000 debit and 95,000 credit. So what is the balance of cash?
50,000. 50,000. I mean.
50. How? 100,000 minus 95,000.
8,000.
5,000.
Yeah. 5,000 debit balance over here. Cash is always debit balance. Okay. So I give debit balance of cash over here. Next account I have is discount. Very simple. It is an income. So there is a credit of 5,000. So what is the balance over here? It's a credit balance of 5,000. Okay. Get it? So I'll put it in the credit side over here. Okay. Finally, I have a credit item. Okay. Take this credit and then The last account I have is what is called as the capital account, where I have only a credit transaction, which means it is a what balance, debit or credit?
Debit.
Credit.
It's a credit transaction because I only have credit transactions. So it's a credit balance. See, if the carry forward is mentioned over on the debit side, it's a credit balance. If it is mentioned on the credit side, it's a debit balance. That's the
Okay.
confusion I think you're having over here. So because
Yes.
ultimately the balance comes over here.
Okay.
It's very simple. If the debits are more, it's a debit balance. If the credits are more, it's a credit balance. Ignore this line item for that assessment.
Okay.
How about if it is
Okay.
how about if it is equal? How about if it is equal? Debit
If it is
balance is
equal,
equal to credit.
if it is equal, zero balance. Like here, see, zero balance. It is equal over here. Zero balance. Here, my debit is more. So it is a
yeah.
debit balance. Here, also my debit is more. So it's a debit balance. Here, my credit is more. So it's a credit balance. Here also, my credit is more. So it's a credit balance. Yeah, so I'm going to keep this into the credit over here. Okay, and this is what a trial balance is. And the beauty of a trial balance is that the total of your trial debits and credits should be equal. Did you understand this? This is the magic of accounting. We just did like 2-3 transactions over here. In real life accounting, you're going to have like hundreds and thousands of items and maybe hundreds and thousands of accounts. That entire trial balance will come as tallied over here.
I have one question.
Sure.
So according to this logic, if trial balance is not matching, that means we posted something incorrectly.
Yes, that's correct.
Okay.
So back in the days when I was doing my CA, there was a lot of manual accounting still happening in India at that point of time. In fact, when I used to go for auditing, my first job was to write down the trial balance by looking at the manual books of accounts. So I used to keep flipping pages, noting down the balance in each of the pages, writing it down on a separate sheet of paper. We hadn't started even using Excel too frequently at that point of time. And then I'll have a big set of numbers that will run into some 3-4 pages, and then I'll have to take a calculator and total the whole thing up. It will not tie. Then I'll have to go and see, is it a problem in me writing down the numbers from the pages to the sheet, or is it a problem inside the book, whether, like what you said, maybe they forgot to post a transaction, or like instead of 50,000 they posted 5,000 over there, or like instead of posting it into debit they posted it to credit. So many different possible reasons are there why the trial balance will not tally, but that was in the era of manual accounting. But today in the computerized account set of accounting, you are 99.99% not likely to encounter a situation where your trial balance doesn't tally, because
That makes
every
sense.
transaction is accounted using double entry system accounting. For every debit there is a credit, so it will tally. But just because it tallies, it doesn't mean that these numbers are correct. Okay,
Right.
when it tallies, what it just means is that you have done the double entry system of accounting correctly. Okay, maybe this is
Not
not
necessarily
an
recorded it.
maybe this is not an income. This balance should be this should be reflecting as a payable over here. Maybe.
I see.
Okay, so the tallying of the trial balance is a primary indication of the accuracy of your accounting only, not necessarily that you have done the accounting in the right way.
That makes sense. That
All
makes
right.
perfect sense.
All right. Good, Rachna. Shall we? Any questions?
No doubt, no, sir. No doubt, sir. I was listening to the story. It's like inspiration, like you never had Excel and now you are trying to do it in one way. There how
Yeah.
normally now it is coming to Excel format. That is
Oh,
inspiration, sir.
yeah. So now let me just carry on with. So this is the trial balance that we saw. You can see the slide now, right? Trial balance.
Yes, sir.
So the trial balance is what we just saw in that Excel sheet. So after you record all the entries for a particular period, you will take a trial balance, and the trial balance will show the all the balances in all your accounts. Like you can arrange it in various ways that you want. Some people like to arrange it alphabetically. Some people like to arrange it based on the groupings, the type of accounts, etc. But bottom line is your debits and your credits will be equal in your trial balance. But and like I said, that is only an indication that your accounting is free of any clerical errors or arithmetical errors, not necessary that your accounting is perfect. For that, you'll have to give your accounts for audit. Okay, so now next concept that we have in accounting is like after you develop the trial balance, you will have to what do you say uh, derive something known as financial statements. And the first financial statement that you would want to look at is called as the profit and loss account. So in profit and loss account, it is basically you're comparing your entire revenue with your entire expenses. So all your income and expenses, all the nominal accounts that we saw in the categorization are summarized in the profit and loss account. And if your expenses are more than your income, it is a loss. And if your income is more than the profit, sorry, income is more than the expense, it is a profit. So that is how it is done. So we will have what is called as a profit and loss account. We'll have to prepare this. So uh, I'll give you some assignments on Tuesday for you to work on that, on how to do this. Okay, if I come to, wait, okay, let me just cover balance sheet also. So there are two financial statements that we're going to look at from a basic point of view. First one is called profit and loss account or the income statement. That's how many people refer it today. The income statement or statement of operations, that is called the P&L account. That statement is the objective is to measure the performance of the business, whether it was operating under a profit or under a loss based on. So what we do is, like I said, we take all the income, like your sales, your other income, anything over there, and then we compare it with your various types of expenses, your purchases, your other expenses like your salaries, rent, general overheads, all those things, and then we compare and then we see whether it is profit or loss. If your expenses is more, it is a loss. If your income is more, it is a profit. Now, that is with regard to nominal accounts. The other two categories of accounts, that is real accounts and the personal accounts, we take those accounts into the balance sheet to show them as assets, liability, or equity. Okay, so assets is basically your fixed assets, inventory, cash, prepaid expenses, and various other current assets over there. Investments, all those things come as assets. So these are debit balances. Okay, so all the debit balance accounts come under the asset side of a balance sheet. Now, your credit balances, you have to categorize between liabilities and equity. So anything that you owe to a third party outside the business, to a creditor, to a lender, are all what is classified as a liability. So liability, and then the remaining, your owner's capital, your what the business owes to the owners. It can be in the form of equity, it can be in the form of preferred capital, or it can be in the form of reserves and surplus, retained earnings. All these things, they form part of equity. So that is called assets, liability, equity, which is why initially when we were covering, we had this formula over here. Assets is equal to liability plus equity. That is from the balance sheet point of view. Just like your trial balance was tally, your balance sheet also should tally accordingly. Your assets should equal to your liabilities plus equity. Clear on this much?
Yeah.
When I
Would you
was reading
Yes.
I was reading somewhere that if the suppose like we told that they will get auditors. You said they will get auditors, no sir. You told one of the meaning. You told that if you get auditors before you then that I was reading somewhere that before give to auditors, you wouldn't have to verify everything you have done correctly or not. Others, some mistakes means they will say that, okay, it's invalid. They will throw it in our face and say, you have done mistake. What is it? That only the logic, no, sir. No, no.
That is
Auditor,
that is there, but it depends. Like like when I was working in Deloitte and EY and all, there if the client's balance sheet is, we see a lot of errors, we give it back to them saying that your accounts are not ready for audit. You fix your accounts, do a review from your side, fix all errors from your side, because these are errors that you should be able to find from your side. And you fix it from your side, and then we will do the audit later on. Okay, so that is what is called self-review of accounts by the client. This can be done only where the company is actually run by a competent financial team, where there are CFOs, chartered accountants, or experienced accountants over there who can look at accounts and know how to review accounts and fix it. But then if the accounts is done by a very junior person and all, and then given for audit, you will obviously find mistakes, and the auditor will fix those mistakes himself, and then obviously he'll charge the client for all that work. That's how it done. So it depends from case to case basis. I hope that answers the question.
sir.
Okay. So now
I have one question, sir. Sorry,
Sure.
sorry to interrupt you.
You
I
call
just
me
wanted
Anish
to.
here. Don't call me sir. I'm not used
I'm
to
just
this
trying to
sir.
be mindful. I'm just still trying to be
Yeah.
mindful, Anish.
No. Yeah. You
I'm
can call
trying
me
to.
Anish. No problem. Yeah.
So, Anish, the thing is that, would you also give us like practice for journal entry as well, like some
I
transactions?
can. So what I'll
Oh,
do is I will share a list of transactions with you,
right.
and you can just list down what the journal entries is in an Excel sheet, like the sheet that I
Okay.
just showed to you over here, right? You
Yes,
can
sir.
just go through that. Yeah. So in this format, you can just list down the journal entries. You don't have to post it into the GL like this. No need to do that. That will take a lot of time. But then just pass. This is the thing. See, if you know how to uh, draft a journal entry, that is the foundation of any accountant out there. I have, over my, 18, 19 years of my career, and like a significant part of it with EY and Deloitte, I have taken at least 1,000 interviews of people during this point of time, and every time my basic criteria of understanding a person's knowledge level is by asking them journal entries. I'll tell them a transaction, what is the journal entry for this? And this is in any job interview, this is the easiest way to understand the skill of a person. Put a transaction, ask for the journal entry, and then wait and see how the answer is coming from the person. If the person is thinking out aloud, and thinking out aloud is fine, but as long as he's thinking out aloud in the right direction, it is fine. Or like if you will know whether the person is bluffing or whether the person is giving you the answer confidently over a period of time based on your experience. You'll know, and that gives the preliminary indication whether to continue with the interview or not. Else you can just wind up the interview in 5-10 minutes and say thanks for your time and all the best. So this is the
Awesome.
primary, this is like the, how do I say it, the first litmus test for any accountant in an interview to assess the basic knowledge of an accountant.
Makes sense. That makes sense. And like that's what you meant by like when folks who hire you, like EY and Deloitte, they hire you for the clients to clean up their books so they're ready for
Yeah,
an actual government audit, right?
yeah. So
Wow.
that depends on the kind of teams that you're in. Like if you have accounting consulting services, they do these sort of things, cleaning up books of accounts and those sort of things. But like if you're in a pure audit function, they're only concerned with auditing the numbers. They will not do the accounting for you. So it depends what
Wow.
kind of a contract you have with them.
That makes sense. Thank you.
Yeah,
Thank you so much.
yeah, yeah. So I know we had kept the session for 3 hours, but then I later on thought it's better that we don't go too fast on this. We just look at the basic concepts. So today my objective was to cover from a transaction to what the balance sheet is. Okay. Now what we'll do is on Tuesday, I will set up some practical, what do you say, assignments for us to do, and then we can work on the practical aspects so that you get a feel of how to draft an entries. Meanwhile, I'll also give you, I'll WhatsApp you some what do you say, journal entry questionnaires, and then you can just try to note down what the entries are, and I'll share the answers on Monday with the folks. So you can just compare with what you drafted and what the answers are, the final answers, and see if it is matching with what your answers are. And if there is a difference, we can discuss this on Tuesday. Does it sound good?
Soon.
Yes, yes, absolutely.
All right.
Thank you.
I hope the session was useful in terms of understanding the basics of. I have gone like really basic. Like this is how my 11th grade teacher taught me accounting. So that's I went to that level of basics over here.
Thank you so much. I personally needed this. I thank you so much. I really, as soon as I walked in, I kind of know how much I don't know. So it's really humbling experience. And thank you so much for doing this. I really appreciate this. Thank you.
So I'll just share the journal entry samples with the both of you on your WhatsApp a little later today. All right.
Yes, sir. Thank you.
Okay. Yeah. And Rushit, do we catch up later sometime your day?
Yeah. Whatever's comfortable with you. I can now or later, whatever's more comfortable with you.
Okay, what I'll do is I'll just ping one of my colleagues, and I would want her also to be on the discussion that I'm having with you. So I'll just check her availability because it's evening time over here. So she might be traveling from office to home at this point of time. Let me check what her availability is, and I will give you a heads up. It won't go beyond 10:30 your time morning.
Okay, perfect. Thank you.
Yeah.
Thank you so much.
Yeah. Thank you, Rushit. Thank you, Rachna. I will share the recording as also with the group later in the day once I get the recording. All right.
Thank you, Rachana. Thank you, Anish.
Thank you. Yeah, have a nice day. Bye.
Bye.